You look at these markets, you could be forgiven for saying there's a sense of mania, there is a sense of panic in terms of the growth confidence and the Fed being behind the curve. How manic a Monday is it for you?
Yeah, it's as manic a Monday as they get. The last time I saw these type of moves, in dollar-yen was pretty much in 2008, in terms of the speed and magnitude and breadth that we're seeing. So it's a manic Monday, no question about it. What we've seen certainly in dollar-yen, I think last week was really interesting in the sense that with the BOJ obviously raising rates, engaging in aggressive sort of tapering of its QE program. But I think the fact that the BOJ said they were likely to raise rates again in the subsequent meetings pretty much indicates that the BOJ believes that sort of growth potential in Japan is probably a lot higher than many had anticipated before. And then obviously we've seen a very aggressive sort of rewind in carry trades, people getting out of long positions in Mex and Brazil and others. And likewise, you're seeing dollar-yen pretty much fall like a stone. We've gone in the space of 2 weeks from 161 all the way down to sort of 142 as of this morning. So it's a very, very aggressive move, mainly short covering move. And I think if we look at sort of the broader dollar, really what we're starting to see, obviously dollar weakness against the safe haven currencies such as yen and the franc, we're now likely to see that sort of widen and broaden. And I think certainly we're likely to see the dollar weakening in a more directional manner against the likes of the euro, sterling and so on. So it's really a case where we're seeing the first leg against safe haven currencies and next against some of the other majors in G10. And thereafter we'll have to see what the Fed's doing.
Okay, let's just put a pause in there because there's a lot to unpack. Let's start with the narrative. The market is now vaulted from, on Friday morning when I started this show, I said there was a nano chance of an intra-Fed rate cut. Now, the last time we had an intra-Fed rate cut was in March. It was in the March 2020. It was in the eye of COVID. It was 150 basis points. Differentiate for me now between COVID 150 basis point cut in March 2020 and now the baying call for an intra-Fed cut, 60% probability. Do you agree that it could come? And if so, what size and scale?
Okay, do I agree whether it will come? I would say probably not. I think that it's unlikely in my view. What we're seeing at present is quite simply, it's not, what we're seeing in COVID. It's not a crisis. It's simply a business cycle, right? And I think the moves you've seen overnight in Japan likely exacerbated by very poor liquidity. Let's not forget that. And certainly if the Fed simply signals that it's likely to cut rates aggressively in the coming months, that should do the trick. They don't necessarily need to cut rates this week, as it were. So I'm not yet in the camp where we'll see an aggressive rate cut, intra-meeting cut. I think that would be really sending panic signals to the market.
And by the way, the first intra-Fed meeting cut in March 2020, Peter, invoked a drop of 3% in the S&P 500 and rates to go 1%. So it was a crisis response mechanism that we saw there. OK, let's move it forward. So the Fed have got to jawbone the market to create the floor, as it were. I haven't seen, if you think about dollar-yen, it was parabolic on the way up, Peter, wasn't it, in terms of the dollar's ascent? Here it is. It's almost like a bottomless pit at the moment. And I want to clarify from you, if you say leg one is short covering, do we go towards a capitulation move of where we trade through? The next leg is to trade through the 140 level and over 142.40 at the moment. So is the next leg, if we are genuinely in a growth slowdown phase, a business cycle growth slowdown phase, do we continue to buy yen, or is the alternative to buy Swiss and perhaps do some more unwinding of the carry?
I think it's likely, yeah. I think we'll go through once, getting a move below 140 is definitely feasible. I mean, if we look at dollar-yen, a fair value in dollar-yen probably closer to 120-ish, maybe 125. So there's definitely more juice in the trade. I think the move we've seen thus far is really, really positioning shift. But if we look at it in terms of monetary drivers, that will be the next leg. And certainly with a slightly higher rate from the BOJ and indeed lower rates from the Fed, that's likely to push dollar-yen that little bit lower. I think that down move will certainly be less volatile than we've seen and less abrupt. But nonetheless, I think the direction of travel is lower. The carry trade really that we've seen in the last several years, it's burst. Many of us for a very long time were saying that yen was absurdly cheap. And certainly that's now unwound, and this process is going to be a multi-month process. It's not going to be something that's done and dusted in a week, I'm afraid.
What do you get from the Fed this week? Is it a jawboning?
Oh yeah, I would think so. I think if they were to cut this week, in an intra-meeting cut, it would really signal panic stations from my perspective. So I think that's just a step too far. But certainly, moving towards, the Jackson Hole Symposium at the end of the month, I would anticipate we'll get very, very strong signaling from the Fed, at which they say, look, September, done deal. Consider 50, and then perhaps we'll see how we go from there. But an intra-meeting cut at this point, we're not dealing with a pandemic. We're dealing with a simple reversal of a business cycle, and so to my mind, an intra-meeting cut would be unjustified.
Yeah, well, as I say, in March 2020, the first response mechanism was to crash bond yields and equities. The second move, of course, put a floor under it, Peter, that cut up 100 basis points. Mm-hmm. Does this give then additional drumbeat to the doves on the Bank of England and within the ECB? I'm just looking at euro sterling at the moment. She's flying higher, cable's a little bit lower, nothing too dramatic, down by 1/3 of 1%. I think that's got a touch of geopolitics in it as well, a reality check for Keir Starmer on the finances and one thing and another. Down 1/3 of 1% is where we are on cable. Does this kind of mania of risk off, which is how I would describe the equity market and the bond market, Peter, is quite literally fraught this morning. I would say bullish, but fraught. Does it add to the narrative of cuts for the ECB and the BOE?
I would say it does. Look, I mean, where the Fed goes, the others follow, right? And certainly vis-a-vis, the BOE in particular, if you've got a very, very close business cycle, what you tend to find is that their respective rate moves move pretty much in tandem, albeit with small lags. I think from the BOE's perspective, they could have remained on hold last week, and in a sense, the Fed should have cut, right? So, they basically, we could have seen a role reversal there. But nonetheless, I think if we look at the BOE, they've signaled they're going to continue cutting rates. 5-year swaps in the UK at around 3.7, 3.6%. So it kind of tells me we're likely to get a front-loaded rate cutting cycle here in the UK. I think 100 basis points in the next 6 to 9 months is feasible for the BOE. I don't think they're going to do a lot more than that. Certainly that was the message we got from Haskell, from the BOE's Haskell. So overall, look, I think that we can anticipate further rate cuts. From the majors. It's a question of speed and timing, of course. But as I said, look, where the Fed goes, others will follow.